All right, hello again, everybody. This is Mike Rixie. I am the lead options instructor for Netpicks. And in today's video, I want to take a look at two potential options trades on SMCI, both of which will tie up less than $500 of capital. Really ideal for a wide range of account sizes, a lot of flexibility. Best of all, it's going to be a risk-defined trade that gives us a nice profit potential. So let's go ahead and dive in. We'll start out by taking a look at the chart patterns, take a look at the technicals that I'm looking at that are driving our decision to take one or both of these trades. Then we'll switch on over to the trade page and we'll actually piece those trades together right in the broker platform. So let's take a look at SMCI. This is the 130-minute chart. This is the one that I have been showing in a lot of our recent videos. It's the one that we use to drive our swing trades. We classify a swing trade as holding a position anywhere from 1 to 20 days. That's what we're looking to take advantage of. It's not a day trading approach. It's not a buy and hold long-term approach. We're really looking to get in and out in just a matter of a couple of days. And if we take a look at the chart, you're going to see all the colored dots there. We have a very specific set of criteria that we look for in every trade. When that criteria is met, we're going to see a setup outline for us on the charts. You're going to have an entry point, target levels, and stop. If we take a look, you're going to have the red dots down below. This is what we call our trend trade. We're looking for a potential push to the downside. Now, it doesn't mean I'm calling a major market top. We're just saying in the near term, we have price ready to roll over, potentially only pull back for a couple days, but that's all we need. We might see this one way higher end of the year. I'm not concerned with what's going to happen months from now. I'm only concerned with what's going to happen over the next 1 to 20 days. Well, if you take a look, we've got our two moving averages here. All right, we've got a 5-period EMA and a 21-period EMA. And you'll see that starting last week, we had price start to roll over. We saw price start to roll over below both of our moving averages. We also had our momentum indicator down at the bottom that was also starting to release some energy on the downside. That's what gave us our red setup here. And if I bring up my data window, you can see my first series of red dots at 52.70. That's my entry point. I know my entry point to the penny. It's either a setup or it's not. And if it's a setup, which it is here, I know exactly where to get in. And then I also know where my target levels are at. Down below, you're going to see two additional red dots. Target 1, 50.65. Target 2, 48.89. And the white cross up above at 59.68, that is our stop. Those levels are calculated based on range in the market. As range expands, as volatility picks up, we're going to go for the larger winners. As range contracts, as markets slow down and potentially get into a choppy stretch, we're going to go for smaller trades. The calculator, the custom indicator that we have here on the chart, does all of that hard lifting for us. It evaluates the market, tells us what we can go for on the target level to maximize our profit potential. It also tells us where to put the stop so we can minimize the risk as much as possible if the trade goes against us. All right, so now we've got this trade setting up on the downside. Now we have to make the decision, how do we want to take it? How aggressive do we want to be? We're going to focus on the options here. So we're going to take a look at either buying a long put or selling a call credit spread. Both are bearish positions. One is more aggressive than the other. So let's jump over to the trade page and let's take a look at our potential options. Now on SMCI, we have earnings upcoming in early November. I want to make sure that I'm out of this position, good or bad, profit or loss, before those earnings are released. Which means I want to select an expiration cycle that comes before those earnings are released. The earnings are out on November 4. I have the October 31st options open here. They have 18 days left to expiration. Very typical for us. We're typically right in and around that 20-day level, 20 days left to expiration. A little bit shy of that, but that guarantees that I can get out of this position before the earnings are released. Let's take a look at the long put first. The long put, the benefit there is it gives us the biggest profit potential. If the stock moves to the downside, we're going to have a big return potential. We could potentially look at a 50 to 100% return in a matter of a few days if the stock moves lower. The problem with the long put is it's going to tie up more capital and you need a lot to go right in your favor. You have one way of making money. The stock needs to move to the downside and it needs to do so quickly. If it does, you're rewarded for it. So if you want to be aggressive, no problem with that approach. But I'm also going to take a look at a call credit spread for those that might say, well, I want a more conservative approach. I'm going to give up the home run profit potential in exchange for a higher probability of trade, a trade that has multiple ways of making money on the position. So let's take a look at the long puts first. The stock trading right around 55, right? The way that I like to identify my long options, in most cases, I'm going to be right in and around the at the money strike or slightly in or out of the money. And I give some flexibility there because I'm trying to identify the option that has the best liquidity. And we look at volume and open interest to gauge liquidity. If I take a look at the 55 puts, plenty of volume, plenty of open interest, and relatively tight markets. There's only a 10-cent difference between the bid and ask. If I were to buy the 55 puts, it would tie up right around $360 of capital. Less than $400 would be my max risk on the trade. If I bought this contract for $360, that's the most I can lose on the trade. And I have unlimited profit potential if the trade goes in our favor. A lot to like about that trade. Can you trade multiple contracts if you have the bigger account? Sure. You can take this trade with 10, 20, 30 contracts. The trade doesn't change. You're just adjusting your position size. You would still use the same entry, same target, same stop. None of that would change. You're just adjusting your position size depending on the size of your account. All right. So if I bought the 55 puts, again, I'd want the stock to move to the downside, and it's time sensitive. I really want that trade to move to the downside within the next 1 to 20 days. We only have 18 days left to expiration, so the sooner the better on this one here. See if we can get some movement on the downside. Now, what if we want a more forgiving trade? Let's take a look at the call credit spread. Let's stick with the October 31st options. Let's go over to the call side, and let's take a look at the 58.60 call spread. All that means is I'm trading two options at the same time. I'm selling the 58 call, and I'm buying the 60 call at the same time. I'm collecting 59 cents or $59 per spread to put that position on. I'm risking $141 per spread. A lot lower risk compared to the long put, but I also cap my profit potential. With the long put, I'm going to typically see a 50 to 100% return on a winning position. With the call credit spread here, in a lot of cases, I'm looking at between a 16 and a 30% return on my capital on a winning position. The most I can make on this call credit spread is $59 per spread. So you look at that and say, Mike, why would you want to do that? Why would you want to cap your profit potential? Well, if I'm looking to lower my costs on the trade, or maybe I look at the market and say, we've had a pretty bullish environment, every dip is bought, maybe I want to be a little bit more conservative. This trade here gives me 5 ways of making money versus only having one way of making money. I make money here if the stock moves up, down, or sideways. As long as price stays below 58, I'm okay. I also make money from time decay adding up. Every day that passes, that's going to help me. The options are going to lose value every day that passes. And then I also make money if volatility decreases. I give myself 5 ways of making money on the position. The ideal scenario is still for the stock to move lower. If it moves lower, I'm going to make money the fastest. If it doesn't, if we just kind of chop sideways or head into more of a drift mode, I can still make money there, but I'm more dependent on the time decay adding up. I have to hold the position a little bit longer in that case to let that time decay continue pushing in my favor. Right? So a lot to like about this trade. With the credit spreads, we're typically risking between 2 and 3 to make 1. Here in this case, I'm risking 141 to make 59. Very typical range there. My target level on this one, I typically buy my credit spreads back right around 50% of max profit. My max profit being my 59 credit that I collected to open up the position. I'd be looking to buy this one back right around 29 cents. That way I can close it out before expiration, take my partial profit, free up the capital, and move on to the next trade. If I want to use a defined stop on this trade, I can use 70% of the max risk. That max risk is $141. I would take that 141, take 70% of it, which is $98. I'd want to get out when the spread is down $98. To get my stop price from there, I have to take that 98 and add back in my 59 credit that I'm collecting to open up the position. And that would leave my stop at $1.57. Everything's still outlined for me. Everything's defined risk. Now we have a decision to make. Do I want to go the aggressive route and go with a long put? If that's you, perfectly fine with that. It meets our criteria. You need more to go right in your favor, but if it does, you're going to be rewarded for it. If you want to be more conservative, if you're a little bit less certain of a directional move, you can take the call credit spread. Both of them ideally want the stock to move to the downside. One is just more conservative than the other. I love this approach. It gives me flexibility. I don't have to swing for the fences all the time. I don't have to put these positions on expecting the market to make a big move. The market will do that and it'll accommodate us at times, and we want to have long options on to benefit from that. But there's also times where I want to be more conservative, take what the market's giving us. In this case, maybe the call credit spread is the better way to go. So we'll continue to track both of these. If you have questions on one or both of these, feel free to reach out. You can either post a comment on the video here on YouTube, or you can always email us info@netpicks.com, and we can definitely help answer any questions you have on either one of these. So again, both bearish positions on SMCI, and we'll see if the market does give us a nice move to the downside here over the next week or so, and we can take these positions off. All right. So I'm going to wrap this video up here. I'll be back with you guys over the next few days. I do have one quick announcement. We do have a live event coming up on October 21st. Free event. All you have to do is click on the link in the description of the video, and we can definitely get you a spot reserved, where I will go through more charts like we did here today in more detail, walk you through the criteria in more detail so you guys can see exactly how we approach the markets at Netpicks. So just go ahead and click on that link and we'll get a spot reserved for you. All right, enjoy the rest of your day, guys, and I'll be back with you over the next few days.
Everything discussed here is our opinion, and it is not to be taken as investment advice, because we are not your financial advisor, nor have we considered your personal situation as your fiduciary. This presentation is for your education and entertainment only. Please review Netpicks' full risk disclaimer and privacy policy.